Hello and welcome to the Utility Week podcast with me, Rob Horgan. As ever, I'm joined by James Wallin to go over the biggest news stories of the past fortnight. However, we're going to do things slightly differently this week. For the first half of the pod, we're going to be focusing on the conflict in the Middle East and the impact it is likely to have on the wider energy sector and is already having. But instead of offering our own opinions, we've enlisted the help of two industry commentators who know far more than we do. So James has been speaking to former Clean Power 2030 advisor Simon Harrison and Andreas Schroeder, who is head of energy analytics at ICIS. Myself and James will then reconvene for the second half of the episode, where we'll be looking at the latest CMA announcements on both the water and energy front. That's it for me for now. Enjoy the rest of the episode, and I'll be back in a bit.
Okay, so I'm here now with Andreas Schroeder, who is an energy expert from the market intelligence firm ICIS. So delighted to have you on the podcast, Andreas. Now, I appreciate that this is it's a fast-moving situation. The conflict in the Middle East. And for our listeners, I should probably just center this as to when we are actually speaking. So this is the morning of the Monday, the 16th of March at the moment. So Andreas, if you could give us your view really on how you think that this conflict is likely to affect the UK energy market. If you could tell us a little bit about what we've seen so far, and your best guess as to what we're likely to see further down the tracks as a result of this conflict.
Yeah, so energy markets have reacted strongly to the outbreak of the US-Israeli-Iran war, and there was a price shock that we observed on markets, especially gas and oil markets. So gas prices have nearly doubled within a few days, just right after the initial shock. Oil prices followed a bit later, a bit smoother initially, but then they reacted stronger the week after, with the conflict seeming to persist for longer. And as the duration of the conflict is now the big unknown question, that's what the market is speculating on. And prices are following any snippets of news regarding the question how long this conflict could persist. And at the moment, we have European gas prices, UK gas prices, around nearly double as high as before the war broke out. And for oil prices, we are now above $100 per barrel, and that's clearly a sign of market shortage. There's risks. There are risks that this conflict could escalate further and it could become a regional conflict. And if so, then the fear especially in the oil market, is there would be quite many oil exporters affected by this supply shock.
One of the things that energy companies in the UK are kind of routinely saying when asked about this is that trying to calm nerves, obviously, saying that at the moment we haven't seen a kind of gas price surge comparable to what happened with the Ukraine war. Is that fair, or is that just trying to keep everybody calm?
So we are nowhere near the price shocks we have seen in 2022 after the Ukraine war broke out. The current situation is different because it is more of a global crisis, and Asia is more heavily affected by the supply shock of Qatari LNG and Middle Eastern oil. On the other hand, we do see price waves coming over to Europe, and it's a very quick change. So it's not as gradual as the shocks that we observed 2022 during the energy crisis, but it's a very abrupt price increase, which is not that inflated yet. So we're 3 times below what we saw 3 years ago. Nevertheless, with the duration of the crisis, prolonging every day, prices are being sent higher as well every day.
Mm.
So
Yeah,
it's
absolutely.
too early to make a call. Will this be just a very short-lived energy crisis? I hope so. If the Strait of Hormuz opens up tomorrow, then we do not even have to speak of a large crisis here. Then it's just a short-lived shortage of gas. But if there is a longer duration of the conflict, then we could speak of another crisis that could unfold.
And is that the really crucial element of this? And the Straits of Hormuz, is there an alternative to that? Is there a way of working around that if that strait does stay closed, if Iran does refuse to open that up?
The issue is that there's not really alternatives available for LNG trade, but to pass the Strait of Hormuz. 20% of global LNG is going via that strait. And for seaborne oil trade, the share is even a bit higher. And there's not really alternatives in terms of pipeline deviations, detours, or anything alike. You cannot fly it out via airplanes, so you need this choke point to pass it, to bring the oil and gas to the market. Alternatives are available in another context. So you could reactivate Russian gas and oil volumes. You could start to reduce the sanctions on Russia to make available other suppliers to the market. So that's what is being considered. And of course, all other suppliers in the world can step in, but they cannot, within a short time, make up the volumes and pick up the slack that Qatar and Middle Eastern countries leave to the market.
In terms of the UK in particular, how exposed do you think the UK is compared to, let's say, some of our European neighbours or other parts of the world? And what options do you think are open to the UK government to kind of mitigate the pressures of this?
The UK is not as heavily exposed to this crisis as Asian countries, for instance. India, Pakistan, Bangladesh, and all East Asian countries are more affected by this crisis. This is especially true for LNG trade, gas trade, and to some extent for oil as well. 15% of European imports of oil came from Middle East last year. So that's not a very strong share. Nevertheless, we do see the price shock that is lifting global prices for oil. So yes, the UK is impacted, maybe not in terms of volume as much as in terms of prices. And for gas, this is true as well. So the United Kingdom is importing a lot of LNG. It is exposed to the worldwide LNG market. And although only less than 5% or around 5% of UK's LNG imports came from Qatar, nevertheless, the global prices are something that the market in the UK feels. Therefore, the British gas price, the market price NBP, went up drastically, and this will be followed by end consumer tariff changes as well at some point.
And obviously, it has been a big debate in the UK over recent years of the kind of influence that the gas price has on wider electricity prices, and there have been talks of electricity market reforms to change that. Do you think that this is going to turbocharge that discussion?
Indeed. So the existing debate on how to shape markets and how to protect consumers from volatility and rising prices, this debate will be fueled by any volatility that we see in the market, that we witness at the moment. The heavy exposure of Britain to LNG, worldwide fluctuations and price rises, this is something the government will reconsider. There are options, there are alternatives available for Britain. Domestic production is something that can be supported further. There are issues about gas storage. the role of gas storage is something that the Britain is currently reconsidering. And I think the debate will continue on these issues. And it will be fueled by any uncertainty that we feel and on any volatility that we see on prices.
And finally, Andreas, what do you think that this means for the Labour government's Clean Power 2030 target? Do you think that this will ultimately be will help to make that argument for the government, or do you think it's going to be detrimental in the face of rising prices in the short term?
I think the current crisis clearly makes a case for more investment into renewable energy, or let's say homegrown energy. Could be renewable or non-renewable, but anything that makes you more autonomous and more independent from global price shocks is something that UK and other countries should follow as a strategy, as an energy strategy. And therefore, I think any future UK government of any color will look at domestic resources, and it will look at investing into renewables as well, because they can protect against price shocks from fossil fuel imports, as long as you depend on these fossil fuel imports. So protecting home markets from external price shocks could be done to some extent by renewables in conjunction with an appropriate strategy on fossil fuel backup.
That was James Wallin speaking with Andreas Schroeder from ICIS. Next up is James's interview with Simon Harrison, former Clean Power 2030 advisor.
I'm here with Simon Harrison of Mott MacDonald, a self-confessed energy geek and former Clean Power commissioner. So an absolute expert to talk about the topic that we're here to discuss today. So welcome to the podcast, Simon. Nice to have you here.
Thank you, James.
So the big topic of today and of the past couple of weeks really is the conflict in the Middle East, what that's going to mean for energy in the UK, and in particular, what I wanted to discuss with you, Simon, was what this means for the Clean Power mission. So we can break that down into a couple of different areas. First of all, there is obviously the bill impact on this, which I appreciate is still very uncertain. It depends how long this current situation is going to go on. But to put it mildly, it's not good news for bills and for Labour's pledge to cut £300 from bills by the end of this Parliament, is it?
No, it's in the short term at least, it's going to push up prices, not just of electricity, of course, but of gas as well, and fuel for mobility. So it's just a really unhelpful thing from that point of view. But we don't know how long it will persist for. I think there is a huge pressure on the United States to act to unblock the supply of hydrocarbons from the Middle East for world markets. So what we might reasonably expect, fingers crossed, is that it's a relatively short-term factor in all of this, and we might see prices coming back down again.
Yep, absolutely. Well, let's hope so. Obviously the short term we have the price cap, which is protecting customers certainly for the next rise coming at the start of next month. You would certainly hope that retailers are in a better position than they were in the Ukraine crisis in terms of hedging. But I guess the big concern is probably not even in the next price cap increase in July, but it's going into next winter, isn't it? Because we're in a very different situation now in terms of the level of energy debt that we've got, and also we know that retailers are operating on thin margins, so it's a concern going into to next winter, isn't it?
Yes, it clearly is, but I think before becoming unduly alarmist, I think we do need to just see how things play out for a little bit longer. This might this might be a piece of volatility that exits the system fairly quickly. It might be something that that leaves some more structural impacts behind. We just don't know at the moment.
Absolutely. Well, let's talk then more broadly about the messaging around clean power, because obviously that has come under a lot of pressure politically from the Conservatives, and Reform have really built a kind of platform on attacking net zero more broadly in the clean power mission and what it's costing customers. And it's been difficult for Labour to hit back at this. But in some ways, I guess the current situation, gives them it gives them a good argument for why we needed to do this in the first place.
I think it does, and it reinforces the importance of resilience, I suppose, of being more insulated than we are from the shocks of hydrocarbon price volatility arising from the current state of geopolitics, and so you look at that, you look at the continuing downward pressure on costs of clean technologies, not just renewables and storage, but things like electric vehicles as well. And so overall, it's I suppose a case study in the rationale for Clean Power 2030. And I guess looking kind of slightly more broadly and long term, it's the beginning of, if you like, a sort of worked example of the extent to which some of these structural forces on cost will actually kind of take some of those the political heat out of the system, because if it becomes manifest going forward that a clean solution is actually going to be cheaper than a hydrocarbon-based solution, then that debate will subside. I would like to think, but so to take a positive spin, it's not a positive spin if you can't afford to pay your bill. But it's but in terms of the trajectory for how this is moving, I think it's another example of why we're trying to do this.
Absolutely. So obviously the clean power, the clean generation side of things is one part of the target. But as we all know, and as you've talked about before, flexibility is a huge part of that. So there's a huge part to be done on the demand side. Now, what we saw back after the Ukraine crisis, of course, was that the National Energy System operator launched the demand flexibility service, and that really caught on, didn't it? It really kind of it caught the national mood of everybody wanting to do their bits, and even if you didn't have an EV or a big kind of low carbon tech thing that you could flex, people were scheduling the dishwasher and turning the lights up, doing all that sort of stuff. It feels like that kind of enthusiasm for flexibility has dampened a little bit over the years. Do you think this is an opportunity to instill that enthusiasm again?
Well, I think it is to a degree, but I think the flexibility, there's lots of flexibility envisaged under Clean Power 2030. I think maybe still room for debate as the amount of that we expect from consumers versus industry. But
yes, of course.
At the moment, the plan is quite kind of loaded towards an expectation of consumer side flex. I think the flex we're envisaging for Clean Power 2030 is not really about people going around turning off switches at particular times. It's something that's much more structural, something that's much more built into tariffs and smart systems. So something that would not be something that an individual would have to act on every day, but much more something that they signed up to the deal and it was all done behind the scenes for them. So all of that, of course, requires progress on digitalisation, which is something that I'm quite heavily involved with the energy geeks in pushing for.
Absolutely,
It's I think it's a trajectory where most people's decisions will be less about we're doing this for the national good and more about, well, we're going to do it because it's cheaper.
Yeah.
And so for me, it's part of the toolkit for reducing costs over that slightly longer period. However, if what this does is create another opportunity for awareness building, and for people to, discover again that you can do this without messing your life up too much, then that can only be a good thing, I suppose.
Last thing I wanted to ask you, Simon, was more broadly. I mean, we've talked about clean power, but obviously this is going to have a wider. It's going to have an impact on everything, isn't it? The price of everything is going to go up. So what does that mean for the kind of wider energy supply chain and the materials that we're going to need to build out the grid and to build the infrastructure we need for clean power?
Well, I think for clean power going, broadly towards 2050, it's again is a reflection of the current state of geopolitics, and it's a reminder that even though we might be able to insulate ourselves from variability in fossil fuels, we still have an issue with the clean technology that is at the heart of decarbonisation, of dependency on critical raw materials. And those critical raw materials, things like rare earth metals, for example, they come from sources that are sort of geopolitically unhelpful, shall we say? And it's not just the sourcing of the materials; it's where the locations are of where those materials are refined and turned into usable product. So at the moment, China has a huge advantage in the control of sources and refining of critical raw materials, and not just things they have domestically, but also ownership of assets in other places. So, for example, mines in the Democratic Republic of Congo, which are very important in all this. So that is a worry. Are we swapping a hydrocarbon dependency for a critical raw materials dependency? Now, clearly, the characteristics of those two are a bit different, but nonetheless, it begs a few questions. And I think there's an opportunity to think again about circularity in how we use and respect raw materials. So equipment standards designing for materials to be capable of being extracted at end of life and then reused in new equipment. I think that's something we haven't paid all that much attention to. We need to think more about, and also substitution. So at the moment, the world depends on lithium for batteries, but there are other battery chemistries which could be as good, could be better, that are beginning to come to market. Sodium batteries, for example, which rely on abundant materials. So there is, I think, a need for deeper thought on the extent to which we want to support and develop the supply of those kind of substituting materials to move us away from such a dependency on the suppliers and refiners of the materials we have at the moment.
And what would be a first step in that, Simon? What would you like to see happening now to set that up?
I think there's a whole. Well, of course, this is all happening around the world, but if we start to more proactively deploy different battery chemistries, we learn about what that means, what the different performance characteristics mean. For example, on circularity, we might want to start to think about product standards potentially to make the things we buy more suitable for dismantlement at the end of their lives. And we might want to give some thought to the commercial models that will allow circularity to happen. So the cost of extracting those critical raw materials and making them fit for further use at the moment is a lot more expensive than simply buying fresh. So what do we do about that? How do we work our way through incentivizing that this is a bit of the economy that we want to develop? Because there's a whole kind of industry and economic opportunity that would come through that. So I've talked about critical raw materials. You could apply it to anything. You could apply it to building materials, and there is a whole recycling and recertification and make available for reuse kind of bit of the circular economy that is missing. So I think it would be something that needs a bit more strategic thought at policy level, I would suggest.
No, absolutely. No. A big debate, which we will continue to return to, not least at our Clean Power conference. You see the plug I got in there, Simon. That was seamless, wasn't it? Absolutely seamless.
Absolutely.
Which Simon will be speaking at. So that is taking place in April, and details can be found on the Utility Week website. So I look forward to discussing this more with you then, Simon. And who knows what situation we'll be in at that point.
Who knows where we'll be? But I guess one thing we can be pretty sure about at the moment is that we're in a volatile world.
Indeed we are. All right. Well, thank you very much, Simon. I appreciate the opportunity to talk to you. Thank you for joining us on the podcast.
Great pleasure. Thank you, James.
Welcome back to the Utility Week podcast. As explained at the top of the show, we're now going to spend the second half of today's episode looking at all things CMA and appeals related. We're going to get through the appeals put in by the 4 gas distribution networks in response to their RIIO-3 final determinations. And we're also going to look at the CMA's final verdict on water company appeals. I think we'll start with water. You think that makes sense, James?
Yeah, why not? Yeah.
Let's start with water. You were unsure there, weren't you? You were going to go the other way.
But that's fine. Well, let's start with water.
I'm going to hit you with some numbers just for anyone who's missed the CMA's final determinations. So in the end, the 5 appellant water companies, that's Anglian, Northumbrian, South East, Southern and Wessex, have been given a further £463 million to spend on top of the original £26.6 billion that Ofwat had already allowed. That is obviously an increase on Ofwat's final determinations, but it is a 4% decrease on the CMA's own draft ruling, which was put out before Christmas. Was it put out before Christmas? I'm doubting myself.
Yeah,
it was.
I think it
was. Yes. Yeah.
October, in fact.
Which is
significantly
I was going to say
before Christmas.
It is, isn't it? Yeah, gosh. So base expenditure allowances are actually £32 million lower than Ofwat's final determinations at just under £14.5 billion. However, enhancement spend has increased by £289 million compared to Ofwat's decision. The other big, I guess, point to look at is the rate of returns for the 5 firms, which has increased from Ofwat's ruling, which put it at 4.03% to 4.2%. But again, that is down around, 0.09 percentage points lower than what the CMA estimated in October. A lot of numbers. I told you. I warned you.
Remember all those numbers.
I've remembered all those numbers. Yeah, I wasn't reading them at all. No, I've memorized them all. So, interesting one. It's a decrease on an increase.
Yeah, they're always really difficult to write these stories, aren't they? Yeah, because you're comparing so many different points of the process. But yeah, so it's really hard to say whether these things are a success or a failure. I mean, you've probably got to look at it from a company by company basis. And on very, very kind of blunt terms, it seems like South East Water have come out best, certainly in terms of percentage terms. Southern got the most extra money. Northumbrian was the only one that has actually got a decrease on where they were with the Ofwat final determinations, but that's just where we're talking about the revenue. There's also lots of other factors that you've got to weave in. I mean, you mentioned the rate of returns, but then there's also various things on uncertainty mechanisms that the CMA have said that they think all of the companies will be up by the end of it. So is it a successful? I mean, they got a fraction of what they actually asked for. So I think they were asking for 2.7 billion between the five of them. They obviously got 463 million, as you said, which was what was that? That was.
You've not remembered your numbers as well.
I have remembered my numbers. I'm not just reading it off the screen. 17% of what they asked for. So that's not a huge win, but they have won important battles on various bespoke projects. They've obviously won an increase in the rate of return, although that's just kind of time and markets that have done that. Is going to go on anyway. Possibly a surprise that it went down from where the CMA suggested it in October. I would have thought that it would have at least stayed where it was, if not gone up. They also
that was certainly the indication I was given on the eve of the announcement that's what the water sector was expecting to see. So
so I think that was a surprise, but it's still an increase from where they were with Ofwat. One of the key points that they did win on, and this is one that we've talked about a lot, and it's one that'll be very germane when we come to talk about the energy appeals as well, is on productivity, on the estimates of how much productivity should increase year on year, which historically, not just in water, but across all regulated sectors, there's been an assumption that companies will get 1% more efficient every year, and that's kind of baked into price controls. The CMA have really kind of stepped out of that accepted wisdom of 1%, and they've set it at 0.7%, same as it was in the draft redeterminations. So that does make a big difference to the companies, and he's pretty much. It's around what they were asking for. It's not quite as low as they were asking for, but it's kind of around that. So that's a big win, and it would be interesting to see the crossover into energy. Although I know that the CMA are keen not to necessarily draw comparisons between the two sectors. They base this very much on looking at the water sector and the specifics of how efficient the water sector is.
What do you make of that? That seems like a strange decision not to rely on your own previous ruling. I know it'll be a different panel of experts, won't it, on the ruling on the gas side of things, but.
And no doubt they will certainly look back at it. Because it is a precedent, and it is the first time that anyone has gone outside of that 1%. I guess they're just trying to temper any expectations. This is going to automatically lead to a change in the energy side as well.
Yeah, interesting one, and leads us nicely onto the gas appeals. I think, as you said, all four GDNs have gone to the CMA as we predicted in December over this OE target, as it's called in energy. It's called the frontier shift in water, isn't it? It's a slightly different term, but means the same thing. Effectively means productivity target. So Ofgem sticking to the 1%, as you outlined earlier there, whereas all the companies asking for significantly lower levels. So I think the four GDNs and National Gas put forward a joint sort of OE target of 0.5% in their respective submissions, and even the TOs as well also called for significantly lower productivity targets, although they haven't appealed.
In SSEN's case, they were suggesting 0.2%, which is surely barely growth at all. But yeah, as you say, they didn't choose to go in the end. This is the point where it's becoming a podcast staple now, where I have to big up Utility Week. That previously it was our awards leading to people getting bought out. Now it's our clairvoyance on CMA appeals. So you wrote a story back in December, was it? I think where we said that the productivity, the OE ongoing efficiency target would be the most likely area for appeals. We've been saying for quite a while, basically since the determinations came out, that the gas networks were the most likely to appeal. Always seemed very unlikely that National Gas would appeal, even though they.
There was a bit of a question mark there. I think so. Yeah. They obviously did the best from Ofgem's draft decision to final decision.
Yeah.
As in they made up the most ground, but they were still the furthest behind, if you see what I mean.
Yes.
Even after the final determination. So there was a bit of a question mark there. But I think, like you say, we knew pretty early on that the GDNs were going to go to the CMA, and we knew pretty early on that it was going to be over this productivity target as well. That was, almost the day after the final determinations came out. That was
indeed,
sort of,
indeed, yeah,
being relayed to us.
We should probably explain for anybody who's not a kind of regulatory geek who might be listening to the podcast that the process in energy does differ from the process in water, where in water the CMA does a full redetermination of the business plan, so it assumes the position of Ofwat and completely looks again at it. In energy, it's different in that they can appeal specific areas of the determination. So, as you say, with this one, it is the ongoing efficiency target solely for Cadent, Northern Gas Networks, and Wales and West. SGN has a slightly broader appeal, which goes into very complicated areas involving
econometric modelling.
There you go. I'm glad you said it, because I can never pronounce that the word. Which and again, so parallels there to water, where the CMA actually came up with a whole bespoke model itself for the redeterminations to calculate base allowances, and the water companies pointed out errors in that modelling first of all, and also challenged really the need to do that in the first place. They're kind of pointing to the recommendations from the Independent Water Commission that the regulation should move away from these big economic modelling, spreadsheet kind of approaches to more of a real world evidence base. But the CMA didn't do that. They said that those recommendations were more focused on future price controls rather than this one. So that's another parallel, and be interesting to see what approach the CMA takes with that SGN one in particular. But for the other three, it's pretty straightforward. It's just on that efficiency target, and they clearly think that it is worth the time and management time and the money it will take to appeal that if they do get a win on it.
Speaking of time, I'm assuming, because I haven't lived through this before, but I'm assuming on the energy side it won't take as long as it did for the water.
Shouldn't do, because the water one, of course, was an extended one anyway. I think the process should take around 6 months, whereas that one took a year. But still, that's the CMA would point out that Ofwat had a much larger team looking at the water company business plan. So to get through all that in a year is pretty good going. But for this one, it should be a kind of 6 months one. It should be much more straightforward.
It is coming back to the water side. I know we're jumping around a bit here, but it is good going to get through all of that in a year. But it has held things up. It has held up progress of AMP8 programs, and
yeah,
we've heard a lot
we're
about
a year
that
in. Now that we've got the results, the water companies have already done a whole year of that 5-year process. Of course, we had the strange situation as well, in that there were originally 6 companies that challenged the final determination in water, because Thames Water also challenged this, but because of their well-publicised financial difficulties, they have never actually got around to triggering that appeal. And I have to confess, I don't actually know what happens now that it was delayed and delayed and delayed. Then it was delayed indefinitely.
Yeah.
So I don't know if there's now a cut-off point now that the final redeterminations are out. I mean, could they come back in like 2034 and go, hello?
Well, they can have a look and say, well, it's not worth it, or actually, let's go for it.
It's a strange situation. Yeah.
It's an odd one. Yeah, I have no idea what's happening there. But I will ask. I'll ask the question. I'll come back on the next podcast if CMA appeals are still relevant in 2 weeks' time. Although, who knows? Any other thoughts on the appeals process, James, or should we leave it there for today? I mean, there's plenty more we could have dug into, but this is becoming a long podcast already. But, we've not even touched on who could be the next Ofgem CEO, which was the topic of... which is another big talking point there. But nothing else on the appeals, really. I think the only other talking point was a bit of a contention from Water UK during the process as to whether the CMA should be factoring in bill impacts when it did its predetermination, which, understandably, when the final verdict came out, that's very much how it was couched, was that the CMA had kind of dampened that increase in bills that the companies were asking for. Water UK's stance was that the CMA shouldn't be getting involved in that. That really what it should be looking at is, is the process fair? Are water companies being given the money they need to deliver the ambitions in their business plan? It shouldn't, affordability really shouldn't come into it. The CMA would say that was a nonsense, and that they take on the full role of Ofwat, and they're redetermining, is that a word? So that would include the responsibilities to make sure that the bill impacts are minimised, bill rises are minimised. So there was only that other thing that I would raise from the appeals. Where do you stand on that?
Where do I stand on that?
Yeah.
I think that's fair. I think they've got to take into account bill impacts, haven't they? I mean, that they ultimately bill payers, are the shareholders of the industry. They are the ones ultimately funding all of this stuff. So yeah, absolutely. I think the CMA has got to factor that in, it's got to be a transparent process as well. So CMA has got to tell the public what it's done and what it means to them. So they've got to talk about bills. I mean, I think this Water UK. I think we're throwing that out there as just another thing to challenge the CMA. I don't think it was a fundamental plank of their objections, but I thought it's an interesting one to get into, isn't it?
I agree.
Good.
And on that note, I think we'll leave it there, shall we, James? And we'll be back in a fortnight's time with another episode of the Utility Week podcast.